Hello and welcome. Today, let us look at what a spread is in Forex trading. So, Forex traders or Forex brokers will quote you two different prices for a currency pair, that is the bid and the ask price. The bid is the price at which you can sell the base currency, while the ask is the price at which you can buy the base currency. The difference between these two prices is known as the spread, also known as bid ask spread. The spread is how no commission brokers make their money. This spread is the fee for providing transaction immediacy. This is why the terms transaction cost and the bid ask spread are used interchangeably. Instead of charging a separate fee for making a trade, the cost is built into the buy and the sell price of the currency pair you want to trade. For a business standpoint, or rather from a business standpoint, this makes sense. The broker provides a service and has to make money somehow. They make money by selling the currency to you for more than they paid to buy it. And they also make money by buying the currency from you for less than they will receive when they sell it. This difference is called the spread. So, when brokers claim zero commissions or no commissions, it's misleading because when there is no separate commission fee, you still pay a commission. It's just built into the bid ask spread. So, how is spread measured in forex trading? The spread is usually measured in pips, which is the smallest unit of the price movement of a currency pair. For most currency pairs, 1 pip is equal to 0.0001. An example of a 2 pip spread for a euro US dollar would be 1.1051 to an ask price of 1.1053. The difference of these two will give you a spread of 2 pips. See calculations above. Types of spread in Forex. So the types of spread you see on a trading platform depends with the broker you're dealing with and how they make money. So the first one will be fixed, and the second one will be variable, or rather floating. Fixed spreads are usually offered by brokers that operate as a market maker or dealing desk model, while variable spreads are offered by brokers operating on a non-dealing desk model. What are these fixed spreads? So fixed spreads stay the same regardless of what market conditions are at any given time. In other words, whether the market is volatile, the spread is always the same. Fixed spreads are offered by brokers that operate as a market maker or a dealing desk model. Using a dealing desk, the broker buys large positions from their liquidity providers and offers these positions in smaller sizes to traders. This means that the broker acts as the counterparty to their client's trade. Having a dealing desk allows the forex broker to offer fixed spreads because they are able to control the prices they display to their clients. So, what are the advantages of trading with fixed spreads? So, fixed spreads have a smaller capital requirement, So trading with fixed spreads offers a cheaper alternative to traders who don't have a lot of money for start trading with. Trading with fixed spreads also makes calculating transaction cost more predictable. Since spreads never change, you're always sure of what you expect to pay when you open a trade. Advantages of, or rather disadvantages of trading with fixed spreads. 1. Records. Records can occur frequently when dealing with fixed spreads since price is coming from just one source, that is your broker. And they by frequently we mean almost as frequent as posts from Kim Kardashian sisters. There will be times when the forex market is volatile and the prices are rapidly changing. Since spreads are fixed, the broker won't be able to widen the spread to adjust for the current market conditions. So if you try to enter a trend at a specific price, the broker will block the trend and ask you to accept a new price. You will be quoted with a new price. Second disadvantage is slippage. So when prices are moving fast, the broker is unable to consistently maintain a fixed trend, and the price that you will finally end up from entering a trend will be totally different from than that of the intended entry price. Slippage is similar to like when you swipe right on Tinder and agree to meet up with that hot babe for coffee, and you realize the actual person in front of you looks like nothing like the photo. Now let us look at variable spreads. So as the name suggests, variable spreads are always changing. With variable spreads, the difference between the bid and ask prices of the currency pairs is constantly changing. Variables spreads are offered by non-dealing desk brokers. Non-dealing desk brokers get their pricing of currency pairs from multiple liquidity providers and pass on these prices to the trader without the intervention of the dealing desks. This means they have no control over the spreads, and spreads will widen or tighten based on the supply and demand of the currencies and the overall market volatility. Typically, spreads widen during economic data releases as well as other periods when the liquidity in the market decreases. Now, let us look at the advantages of using variable spreads. So, variable spreads will eliminate experiencing records. This is because the variation in the spreads factors in the changes in price due to market changes, conditions that is. Trading forex with the variable spreads also provides more transparent pricing, especially when you consider having access to prices from multiple liquidity providers. Usually means better pricing due to competitions. What are their disadvantages? Variable spreads aren't ideal for scalpers. The widened spreads can quickly eat into any profits that the scalpers makes. Variable spreads are just as bad for news traders. Spread may widen so much that what looks like a profitable can turn into unprofitable within a blink of an eye. So which is better between fixed and variable spread? So this will depend on the need of the trader. So there are traders who may find fixed spreads better than using variable spreads. The reverse may also be true for other traders. Generally speaking, traders with small accounts who trade less frequently will benefit from fixed spread pricing, and traders with large accounts who trade frequently during peak market hours will benefit from variable spreads. Traders who want fast trade executions and need to avoid records will want to trade with variable spreads. So how do you calculate spread costs? And you need to know how spread relates to the actual transaction cost. So it's pretty easy to calculate, and all you need is two things: the value per pip and the number of lots you're trading. Let us look at an example. In a Euro USD case, you can buy Euro USD at 1.35640 and sell it at 1.35626. The difference between the two, which is 1.4 pips. So the 1.4 pips difference is what you'd get as loss if you were to buy the Euro USD and then cross the trend immediately. So to figure out the total cost, you'd multiply the cost per pip by the number of lots you are trading. So if you were trading mini lots, that is 10,000 units, the value per pip is $1. So your transaction cost would be $1.40 to open this trade. The cost per pip is linear, which means you will need to multiply the cost per pip by the number of lots you are trading. If you increase your position size and your transaction cost, which is reflected in the spread, will rise as well. For example, if the spread is 1.4 pips and you are trading 5 mini lots, then your transaction cost will be $7. Remember, transaction cost is just another name for the bid ask price or spread, bid ask spread.